Target stock's down 5% this morning. Should you bust out your red card and buy a couple shares of Target? We'll talk about that and more on today's show. What is going on, investors? Hopefully, you guys are having a great day out there. Yesterday, it was Walmart. Today, we are taking a look at Target. This stock over the last year up 61%. Year to date, up 50%. I couldn't believe it. I was looking at this stock chart. This stock was under $100 in March of 2020, and it has just rallied hard. Just a couple days ago, we were at $265 per share. Now the stock is pulling back. We'll talk about what this means from a technical level. Looks like we've made kind of a double top on this one. We'll talk about if we can buy the dip if and when Target begins to pull back. Now the pullback is on the heels of releasing Q3 earnings that came out this morning. Now initially the stock was up about 1.4% pre-market, but I think the street is digesting the news a little bit, and they are digesting the fact that Target and Walmart are taking the same line when it comes to cost inflation, whether it comes to the cost of getting the goods in the store or just the overall cost of those goods kind of inflating in price. Target and Walmart, I think, are making the wise decision to eat those costs and not pass them on to competitors, because as we look through these financials, this is a company that can absolutely eat cost for a little while. And guess what that allows them to do? Gets to allow them to retain customers. And I guess their competition might not be in as a good a spot as Target and Walmart happen to be, and their competitors might have to raise prices, therefore driving even more traffic into Target. We'll see if that materializes over the next year. But I tell you what, if you're a fan of inflation, or even if you're not, I think you actually hope it sticks around for a little while, because I think Target and Walmart illustrate the fact that they can eat these prices. The stock can take a little bit of a hit, but guess what? Their competitors are going to get absolutely blown away, because they are not going to be able to eat a lot of that margin that Target and Walmart are able to do given their size. Now, speaking of size, our revenue came in the most recent quarter at $25.6 billion. That is up 13% year over year. We'll take a look at that when we look at these financials, the 25.6 and the 13% growth rate. We'll run through all the cost and see how the costs are running through to our operating profits over at Target. Now, for the all-important Q4 that's coming up, in fact, we're in Q4 right now, the company is expecting high single-digit to low double-digit growth rate in comparable sales compared to the previous guidance of a high single-digit increase, and operating income will be in the 8% or higher. So the company basically coming relatively in line with where they were at, coming up against tough comps as well, and obviously a tough shopping environment with the cost of energy and gas just absolutely through the roof this time compared to last year. People just likely probably have a slightly less money than they might have spent in Q4 of last year for the holiday season. We'll see how that materializes coming forward. 3 months ended here on our Q3. Our left-hand column is our most recent quarter. Talked about how our total revenue came in at this $25.6 billion. That's up 13.3% over a year ago period where we were sitting at about $22.6 billion. Now, for the 9 months, we're up even a little bit nicer on that from the comp sales. We're up about 15% from 65 up to about $75 billion. Now, what I am really looking for when we're looking at Target are these cost of sales. Those ticked up 17.4% in the most recent quarter, showing you that there are some supply chain, there is some inflation in these costs, because when you look at the 9 month, our costs are only up 14%. So they've accelerated in the most recent quarter, went from 15.5 billion up to 18.2. But what Target did a really nice job of is they didn't see a lot of inflation in their selling, general, and administrative expenses. So they didn't see a lot of impact on that wage inflation. In fact, over the last 9 months, that cost was up 8%. But in the most recent quarter, we just saw this up 4.6%, really just a rounding error from about 4.7 up to about $4.9 billion. Now, we heard on Walmart's call yesterday, the CEO of Walmart said he's not having any problem finding workers. He's not having any problem having employees come through the door and working at Walmart. Well, I'm going to assume Target's probably in a similar situation. That is good, because if you have enough people coming through the door willing to work at Target, it means they don't have to bump those wages up as much as maybe people were anticipating. And I think we're seeing evidence of that in this cost structure. The fact that this barely moved, it's showing you that they're able to attract employees at whatever wage that they are offering at the time. That is good because wage inflation would really, really eat into Target and certainly Walmart and any retailers' profits and operating income, and we're not necessarily seeing that here when it comes to Target. Now, the operating income just up 3.9%. Okay, so our total revenue went up this 13%, but our operating profits went up about 3.9%. Really just very close to a rounding error, right? You're at $1.9 billion. Now you're at basically $2 billion in operating income, just up marginally. Again, most of that got chewed up by the fact that our cost of sales, those cost of goods, basically went up quite a bit in the most recent quarter. But we are seeing evidence that this company absolutely can absorb those costs and likely can do it in the shorter to intermediate term. Now, will it have an impact on the stock? Likely. We'll talk about that from a technical perspective as well. Now, from an operating perspective, over the last 9 months, you see how difficult and how challenging a period this was for the company, because look, the operating income over the last 9 months is up 45%. It went from 4.7 up to this $6.8 billion. My guess is some of these comps back in October might have had some store closure, might have had some shrinkage in terms of profits due to the health situation. So this comp might look a little bit better than it normally would have in a more normalized environment in 2020. But what we are seeing in the most recent quarter is kind of a flattening out of that operating income, simply because the company is seeing a little bit of cost inflation on the goods that they are stocking in Target. Now, on to the balance sheet. I think the most important thing when we're looking at a retail as we head into Q4 is this inventory line. Now, Target does have some cash on the balance sheet. It's a little bit less than where we were a year ago and a little bit less than where we were back in January. But when I run through the cash flows, you'll see this company doesn't necessarily need a lot of cash. And so I actually respect the fact that they only have this $5.7 billion, and I say only, but $5.7 billion worth of cash is not a tremendous amount of cash. Where do they got a bunch of their money in their current assets? That's sitting in inventory. That came in at $14.9 billion, basically $15 billion worth of inventory. Now, you'd expect that to compare favorably to the end of January. As this company rolls through Q4, they probably don't start to really look to restock the stores until maybe even back to school time. Okay, they're not really stocking the shelves until you really get into back to school and you get into Q4 of the holiday season. But compare it to a year ago where they were sitting on only $12.7 billion worth of inventory. Now we're all the way up to 14.9. So we hear a lot about the supply chain. There's boats just sitting off the coast of California and around the world. Well, it doesn't look like that's hurting Target's ability to have inventory in the store. That should be positive for you as an investor in Target. The fact that they have way more inventory. I mean, we're talking about over $3 billion worth of more inventory sitting in the stores right now than they were a year ago. It's showing you, yes, maybe they had to air freight some of that stuff in, and that's where some of the costs are being absorbed, but at least they're going to have most of the products sitting on the shelves over at Target. From a liability perspective, they do have some long-term debt, not a lot. It looks like they paid that down a little bit. We'll look at cash flows on that sense. Now, when we come down to those cash flows right here, we come down to 9 months. We pull down a fantastic net earnings, okay? $5.4 billion last year, just at 2.9, basically $3 billion on that net income. Again, likely some of that is probably virus related. I'm assuming there's probably some costs there and some sales that went out the door that didn't necessarily benefit the company. More normalized environment, this company's printing about $5.4 billion to that net income side. And even if we add back things, subtract some things, we get down to about a $5.6 billion cash provided by those operating activities. That's fantastic, okay? The fact that this company spent about $2 billion when it came to investing activities, the vast majority, in fact, almost all of it, came from buying property, plant, and equipment. So they actually increased that over the last year. They were at about $2 billion last year. Now you're closer to about 2.5. And here's where the cash kind of left the company, okay? The cash, we talked about how they actually had less cash than they did last year. They actually have $2.7 billion less cash than they did last year over at Target. And the most of that is the fact that they did pay some dividends, about $1 billion. You did reduce your long-term debt just a little bit, but most of it was this repurchase of common stock. They repurchased, boom, $5 billion worth of common stock over the last 9 months, and that could be why this stock's absolutely been blowing up. But one of the reasons why. And what I noticed in their press release, they talked about how they have another $14 billion left on this buyback. So you got quite a bit more left on this buyback, and I would expect Target to continue to buy back the shares since they don't really have a lot of use for these cash flows. Okay, you did $5.5 billion worth of cash flows. You spent a little bit more on property, plant, and equipment, but they built out enough stores here. You got you're well covered on this dividend. So they are deciding to buy back those shares since this company doesn't really have a need for a lot to have a really rather large cash balance at the current time. Now, from a technical perspective, this one looks like we've made a double top. So we made a top back here back in August, and then we topped out here really just a couple of days ago, and the stock is starting to pull back. We'd expect it to come back probably, I would guess, at least to the middle of this range. I would expect this stock to come down here to about $245 per share. That's only about $6 or $7 lower than where the stock is right now. Now, I think even lower than that, you've got a bottoming pattern down here at about $230 per share. That's about $22 lower than where the stock is today. This is where the first area where I would get pretty excited about this one. Now, what you have to understand, you come down to this 230 level, well, the trend is completely broken. And I want to show you that the trend is broken on Target, okay? I'm doing that. You could have drawn this upward channel way back here, back in March of 2020, but this stock was in a just a beautiful, like Google-like channel, okay? And then what happened is we broke, and then often you see you come back, you try to back test up to this channel line, didn't quite get there. In fact, it just got back up to the highs, and then usually what you see is this thing walk back and walk back down as sellers have started to step in here at the $265 level on Target. Now, you got a 19 forward PE on this one. Now, the earnings are likely to come back a little bit, okay? And so I wouldn't necessarily trade this one based on its PE because like we talked about, Target and Walmart are deciding to eat a lot of the inflation costs. They're deciding to absorb those costs instead of pass them on to consumers for the most part. You're probably seeing some price increase across Target, but probably not as much. And on top of that, we saw really positive comments by the Walmart CEO about wages and the fact that they are not having trouble hiring workers. And I would assume that Target's probably in a similar boat. If these companies were having trouble getting workers in the door, I probably wouldn't be very excited about buying the dip on this one because the wage inflation would really impact earnings going forward. But if you believe, even if you don't, I don't think your opinion on inflation doesn't really matter. If it sticks around, I think it's good for Target. If it goes away, I think it's good for Target. Okay, it was really that wage inflation that we were worried about. Since I think that's off the table, at least at the current time, if we base it on what we're hearing from the CEOs out there, well, I think you can buy the dip on this one. First spot is 230. Just understand if you break through this 230 level, in fact, more specifically, probably these lows here at 225, well, this one's coming way lower. I mean, the next area of support is not until you get to about $200 per share. So just understand, I wouldn't necessarily put a full allocation. Say you wanted 10 more shares of Target. I think you could nibble down here and wait for this reversal to happen, okay? This reversal happened back here, back in kind of the October timeframe. You started making higher lows. Stock went from 230 and back tested all the way back up here to 260. I think you could see a similar formation as this stock starts pulling back. You'll see it make a kind of a U-shape, V-shape, higher lows, big green candles show up. That is when you can be assured that buyers are stepping in at this 230 level, and you could buy a little bit more aggressively here. I wouldn't necessarily buy this on the straight line down because, like I said, if you break through 230, you're likely breaking down all the way back down to $200. And look, this stock has been on a mega uptrend. You've got to expect this one to pull back, to consolidate sideways. In fact, that's what I would bet on, is we see some sideways consolidation, or we simply are just bouncing up and down between about, we'll call it about $225 per share, back up to about $250, $260 on target. That was target. TGT, the stock's pulling back. You could probably buy the dip if this continues later on this week or into next week. Hopefully you guys enjoyed this video. I'll be back again soon with more. Good luck with your investments.